Good evening, everyone. Hope you all are doing well. On behalf of NISM, I, Kiranjit Kaur, welcome you all and take this opportunity to introduce today's speakers, Mr. Naveen Wadhwa sir and Mr. Dipen Mittal sir, for this webinar on taxation aspects of securities, markets, and products. Being a chartered accountant, at All India 24th rank, Mr. Wadhwa is a seasoned expert with a wide range of skills and experience in income tax, international tax, and technical product developments. He currently heads the Taxman's Research and Advisory Division. He writes and speaks regularly on income tax issues and for taxmen and renowned media houses. We heartily welcome you, sir, that despite being unwell, you joined us.
Thanks,
we are also
Kiranjit.
great. Yes, thank you, sir. We are also grateful to have Mr. Dipen Mittal, sir, who joined us on a very short notice. Briefing about Mr. Mittal, he is a qualified chartered accountant with extensive experience of advising various organizations and experts on different direct tax issues, including withholding tax, capital gain tax, etc. Mr. Mittal actively writes and speaks on direct tax matters and frequently contributes to the media on income tax issues. We welcome you both, sir, and over to you.
Yeah, thanks, Kiranjit. And so I'll be the first speaker in today's webinar on taxation on securities market. And believe me, guys, it's a privilege for me that I got this opportunity from NISM to speak on this event. And again, it's a privilege for us that me and my team, which led by Dipen, who developed this content for this course on taxation on securities market. So before I start with a lighter note. As I see the number of participants, just like Sensex and Nifty, it's going up and up, and it gives me good feeling that I got this opportunity to speak in front of more than 500 people. And with that, I start my presentation, and I just need a confirmation if my screen is visible. Dipen, just quickly give me a confirmation if my screen is visible.
Yes, sir, it is visible.
So this would be the agenda for today's session. The first point I'll talk about is the common factors for the calculation of capital gains, then taxation of equity shares, taxation of mutual funds, and taxation of future and options. So why I chose to have a separate section on the common factors, because I didn't want to discuss again and again the same factors for the calculation of capital gains. So that's why we decided that we should bring them as a separate section so that it becomes easy for you. You can use this PPT as a ready referencer while while computing the capital gain for any of your client or for yourself. So what are the common factors for computation of the capital gains? So this is the computation mechanism wherein you first need to calculate the full value of consideration. Though in the securities market, it becomes very, very easy to get the calculation of the capital gains, because your broker will anyway compute the taxation P&L for you, be it from derivative or mutual fund or equity shares, and they give you complete detail you need for reporting in your ITR. Yet, for the education purpose, for the academic purpose, we are just giving you how do you compute the capital gains. The first step is the full value of consideration. So full value of consideration is the total amount you get when you sell your shares or mutual funds. Then you deduct all the expenses you have incurred wholly and exclusively in connection with the transfer. So here, some people may have taken the borrowings, and you may have got whether can I claim a deduction for the interest from the full value of consideration while calculating the capital gain. So that depends on the type of investment you have made. From listed, you may not be able to get the deduction for the interest, but otherwise you may get it. Then the cost of acquisition and the indexed cost of acquisition. So what is indexed cost of acquisition? I'll explain it in the subsequent slides, again in the common factors for computation of capital gain. Then the exemption under section 54F. Though we have got multiple sections for the computation of capital gains exemption, starting from 54, then 54B, D, G, F, GB. But for our purposes, only 54F is relevant, because the other exemption provision, they have got the separate conditions. And when I talk about the securities market only, then only the 54F is the relevant section under which we can claim the exemption. and the resultant value is either the short-term capital gain or the long-term capital gain. So how do you compute the short-term and long-term? I know you guys are getting excited and may have got a lot of questions. I'll answer all your questions in the subsequent slides. So the first step to compute the capital gain is to determine whether your capital asset is a short-term or a long-term. I am not explaining what is a capital asset because I am assuming whatever securities you hold would be a capital asset. It could be stock in trade, which Dipen will discuss when it comes to the taxation of the profit or gain from selling the securities held as stock in trade. But for capital gain purposes, assuming it's a capital asset, then to bifurcate to determine the nature of a capital asset, we have to distinguish into long term and the short term. Why this distinction is made? Because the long term capital asset are taxable at comparatively at lower tax rates. They get the indexation benefit, and thereafter the period of holding again is different for long term and the short term. So here is a glimpse, and you guys, you can take a print of this slide and keep it in on your table to quickly identify if it's a capital asset, is a long term or short term. So when I talk about the shares, be it listed or unlisted, equity share or preference shares. So this is the first note, talks about the shares. If it's a listed share, then the 12-month would be the period of holding to determine if it's a long term or a short term. If it's unlisted share, then 24 months. It doesn't matter if you hold the listed share, but you do not sell it through the stock exchange. It could be possible that you transfer some shares, listed share, off the counter. Even in that situation, the 12-month period of holding would apply. When I talk about the units of equity-oriented funds, so what are the equity-oriented funds which invest more than 65% in the equities? But if it's a fund of funds, then it should invest more than 90% of funds, the investable funds, in those funds which invest more than 65% in the equity shares. In that situation, whether these are listed or unlisted, the 12 months would be the period of holding. When I talk about the other units, be it REIT, InvIT, uh, uh, the Nasdaq ETF, gold ETF, then the 36 months is the period of holding. Then we have zero coupon bonds. We have 12 months, both for listed and unlisted. When I talk about the other bonds and debentures, if it's a listed one, then the 12 months is the period of holding. If it's unlisted, then 36 months is the period of holding. So guys, you see in shares and bonds and debentures, there we have got two different period of holding to determine the long term or the short term. And for all other securities, the period of holding would remain same. For your reference, I have also mentioned about the immovable property. If you want, you can ignore it for, I'm ignoring it for our discussion purposes, but you can keep it for your reference for advising to any other client other than on securities. So now coming to the next slide. So why this distinction is made, as I mentioned, the indexation benefits are allowed because government would give you some additional benefit if you have held some capital asset for a longer period. The inflation must have reduced the value of the cost you have actually incurred while acquiring that capital asset. So considering these aspects, the government allows you to claim the indexation benefit of your cost of acquisition. Yet in many cases, the indexation benefit is not allowed. Why it is not allowed? There can be n number of factors. Your capital gain is taxable at a concessional rate, like the shares you sell in the stock market. I'm talking about the equity shares, and because they are taxable at just 10% and in excess of 1 lakh rupees, since you're already taxable at a concessional rate, so they do not give you any indexation benefit. Similarly, debentures and bonds, because you are not taking any risk, and in any ways your rate of interest on bonds and debentures are slightly higher than your inflation rate. Because of that reason, they you do not carry any risk and your inflation has been beaten by the returns. And because of these reasons, the government do not allow any indexation on the bonds and debentures. But there are two exceptions to this rule, that is capital index bonds which are issued by the RBI, and the sovereign gold bonds, again, which are issued by the RBI on behalf of the government of India. So now let's talk about the shares wherein you can claim the indexation benefit. So these are unlisted equity shares and preference shares. Then capital index bonds and sovereign gold bonds, immovable property, physical gold, other capital asset, except those which are specified in note allowed. So what are those shares which are specified in note allowed? I just move this screen a bit. Yeah. So listed shares, listed equity shares, share purchased by non-resident because these are taxable at a low rate, written InvIT units, debentures, other bonds, uh, purchase of unlisted securities by non-resident, purchase of securities, any securities listed or unlisted by an FPI, purchase of units in foreign currency by an offshore fund, purchase of GDRs in foreign currencies, then units of equity-oriented mutual funds because they are taxable at non-concessional rate, at a concessional rate, and then non-equity mutual funds, which are basically debt-based funds. And I'll touch upon all these points in the subsequent slides because these are the common points applicable for all the securities. So that's why we have captured at one place. After next slide, I'll take a pause and we'll take few questions if you have. Okay. So I'll take a pause here. Now, guys, if you have any question till here on the computation part, on the period of holding part, on the indexation part, I'll taking a pause for 1 minute and we'll give you a chance to put your queries in the chat box.
Hello.
Yeah. So I have got one query from Rupendra Ghosh. Sir, for ETF like Nifty, Bank Nifty, what will be the long-term period? So, Rupender, you can take ETF just like your mutual funds. Actually, technically, ETF are mutual funds because they invest in the equity shares. And if they invest entirely in the equity shares, because when you talk about Nifty or Bank Nifty, eventually they invest the amount in the same proportion in which those components in the Nifty or the Bank Nifty constitute. So it means since they are investing more than 65% in the equity shares, they should be taken as equity oriented funds. In that situation, the period of holding would be the 12 months for the listed ETF. The unlisted ETF does not exist, so I'm not talking about the unlisted. I'm talking about the listed ETF. So the period of holding would be the 12 months. Okay, and so gold bond time frame. So that should be taken as I'll go back to the previous screen again. Okay. So the gold bond would fall in this. If these are the listed one, then 12 months. If these are unlisted one, then 36 months. Okay. Karthik, I am not, because of the lack of time, I am not explaining again. You are requested to kindly go through the slides. These are self-explanatory. Hi, so for the indexation benefit, the new category of multi-asset fund have an indexation benefit. So what would non-equity mutual fund comprise of? Anonymous attendee. I'll cover this point in the subsequent slide. When I talk about the mutual funds, I'll cover this point and it would answer your question. And capital gain statement is mentioned that the valuation of funds before indexation and after indexation, which one is to be considered for taxation purposes. So if the indexation benefit is not allowed, which you can see from the next slide, then you have to take the cost of acquisition before indexation. If it is allowed, then after indexation. Index ETF, no, the indexation benefit would not be allowed because they are taxable at a concessional rate. But if you transfer it off the counter, in that situation, you can claim the indexation benefit, but make sure that you do not pay. Always do a calculation if you sell it online, if you sell it offline, how much additional tax you would be paying or saving. Only then you take a decision. Otherwise, off the counter, if you're selling it, then you can claim the indexation benefit. Interest deductions are allowed for which all security asset, which are the relevant criteria for taking the deduction. Though the income tax law is silent, it simply say that you can claim the deduction for all the expenditure incurred wholly and exclusively for the purpose of transfer of shares, transfer of capital asset. But the problem is it becomes very, very difficult to prove it that you have taken the loan for the purpose of investment. And it talks about in connection with the transfer. It does not talk about in connection with the acquisition, right? So it won't be possible for you to claim the deduction for the interest component. Indexation benefit on sovereign gold bonds, yes, it is allowed. What do you mean by capital index bonds? Okay, so I'll just take two more queries: capital index bond and US stock market. Then I'll continue with my presentation. So capital index bond, basically they used to be called capital indexation bond, and these were issued by the RBI, but now I think these are called inflation index bonds, something of that name they are called, and these are issued by the RBI. I'm not aware of the timing when these are issued by the RBI, but the name has been changed from capital index bond to inflation index bond. I think now they are called IIB. What is the taxation of investing in the US stock market? Ashish Naria. Though this question does not pertain to today's webinar, but I'll quickly answer your question. So your US stock market would be taxable just like your unlisted equity shares. So what does unlisted equity share say? So it says 24 months would be the period of holding, number one. And now coming to the next point, the indexation benefit would be allowed. As I mentioned, unlisted equity shares. On the tax rate part, I'll cover it when I come to the relevant slide. So I hope that answers your question. Now I'm taking the first section, that is taxation of equity shares. So I'm assuming the participant in today's webinar, they would be either trader or investor, and that is quite common. And we often buy and sell share the same day. If the market goes as per our calculation, and sometimes we book the profit, if not the same day, one day after, 7 days after, maybe 30 days after. So that in that situation, I would say it's the risk, but technically it may not be the risk in your case, may or may not be. Why I'm saying that, Dipen will explain it in when he starts speaking on the classification of taxation of traders and investors. But why I'm saying this, when I take my gains or losses from the stock market as capital gain, so the calculation is pretty simple. I take the full value of consideration, I reduce it by the cost of acquisition, and the remainder value is my capital gain. But in case of an investor, he can claim every expenditure he incurs. So he carries a laptop, he can claim the depreciation on that laptop. He pays for the internet connection, he can claim a deduction for that. He can claim a deduction for his vehicle, which he uses to travel from home to office or for any other business purposes. But in case of an investor, these deductions are not allowed. But in case of a trader, all these deductions are allowed. So why we should not go for a trading, or rather showing it as a business income? And that challenge comes when these are taxable at the rate of 30%. I mean to 30% means as per your the slab rate. Since the high rate is a 30%, I am taking that as a just for calculation purposes. While in case of investor, it would be taxable either 10% or 15%. If I talk about the equity shares only. So this is the reason it becomes very, very challenging, not for you, but for the department as well as for the courts and tribunals to decide if the investment in the shares are actually the capital asset or the business asset. So how you can determine it? There are a lot of guidance and instructions by the CBDT as well as the courts. Using that, we can easily identify if you should classify your investment in this shares as stock in trade or as a capital asset. But whatever stand you take, you have to follow it consistently. You can't change your stand every year, every single year. So in year one, your calculation says claiming as a capital gain would be beneficial, but in second year you say, yeah, I have incurred losses, it's better I claim it as business. So you can't do that. Your assessing officer would not allow you to do that, right? So now coming to the next slide, how you can actually do this classification. All right. So these are the common factors. So the row number first, second, and third, they are pretty simple. It won't be difficult for you, and the department may not even challenge it, because there is a circular number 6 dated 29th February 2016. It clearly says if you have classified your investment this year as stock in trade, department will not challenge it at all, and you can claim it as your business income, be it more than 12 months or less than 12 months. Mind it, but the whatever stand you take, it should be followed consistently over the period. Now, if your investment has been held for more than 12 months and you claim it as a long-term capital gain, then again department will not challenge it. So your stand would be accepted by the department. The problem arises is when your investment in the shares were held for less than 12 months, and now you want to claim it either as a capital gain or as a business income. Obviously, you do your own calculation, and whatever way is more beneficial for you, you will go with that opinion, with that option. So how you can determine, and what are those factors which not just the department but the courts will also consider. So these are how do you account for these investment in your books of account. Do you maintain a separate records, because these records will show you your intentions at the time of buying, how frequently you buy and sell those shares, what is the ratio between purchase and sales, and the motive was to earn the profit when the price increases or just to earn the dividend. So if you say the price was to earn the profit in a shorter period, then should be taxable as business income. But you say, but my motive was to earn dividend. So in that situation, it should be taxable as capital gain. So guys, you can again take a print of this slide and keep it in, use it as your ready referencer. And these are the two common circulars. You can use Google to get the bare copy of these two circulars, wherein the department has explained all the situations in a very detailed manner. Circular number 6 of the year 2016 and circular number 4 of the year 2007. So now coming to the next slide. And with that, I request Dipen to take over. And Dipen, do you want to sharing? You want to have the sharing right, or you want me to control the slides?
So you can control it.
All right.
I will let you know to change whenever I require.
Carry on
now. So thank you, sir, for enlightening us on the distinction between a trader or an investor in equity shares. Now that we are clear on this classification, it sets the stage for us to explore the tax implication in each scenario: taxation of investors and taxation of traders. So let's first begin with the taxation of investor in equity shares. As Naveen sir has already touched upon previous issue, like how period of holding is determined and how the classification of an asset is made on basis of period of holding and the computational aspects. So let's quickly summarize the computational and tax provisions for a taxation for the investor's point of view. So when shares are held as an investor, any gain or loss upon their transfer falls under the tax head of capital gains. So if you are holding shares as an investor, then any gain or loss will be chargeable to tax under the head capital gains. You cannot show it under the head business income. For calculating capital gains, you have to classify the capital gain into either short term or long term. So on basis of period of holding, the asset, basically the equity shares are classified into long term and short term. So if the period of holding, I'm talking about only listed share here. So if the period of holding is more than 12 months, then the shares are classified as long-term capital gain. And if the period of holding is less than or equal to 12 months, then any gain or loss arise from transfer of such shares is considered as short-term capital gain. 12 months is for listed shares, as the sir had already explained. 24 months is for the unlisted share, and in general, the period of holding is considered as 36 months. So can you please move to the next slide? So now we have understood how the capital gain is bifurcated into long-term and short-term. So let me talk about the tax on long-term capital gain. The long-term capital gain actually, the tax on long-term capital gain actually varies based on where the transaction occurs, whether the transaction occurs via stock exchange or through off-market deals. If the transaction happens on a recognized stock exchange, actually when you transact through a stock exchange, then on such transaction, you are liable to pay STT, Security Transaction Tax. As a tax has already been paid in form of STT, the government has given some concession in the income tax when you transact through stock exchange. So if shares are traded through stock exchange, then taxes are levied at a concessional rate of 10%. But in such cases, there are some benefits which are not allowed. Whereas if in case of off-market transactions, the shares move between seller and actually the buyer via delivery instructions without STT. So in that case, the long-term capital gain is charged to tax at a higher rate. The higher rate is actually the 20%. So let's move to the actually the computation as well. We will first talk about the computation, how the computation is made in case of long-term capital gain. So simply you have to actually reduce the cost price of share from the sale price. Transfer expenses are also deducted when computing the capital gains. But one thing which is important to note here is that the security transaction tax which you have already paid is not allowed to be actually deducted as a transfer expense, or it is not even actually added to your cost of acquisition of shares. However, apart from STT, there are some extra charges like stamp duty, like SEBI charges, like exchange charges and brokerage fees, etc. These all are actually included in the cost of acquisition of shares. So indirectly, you can claim the tax benefit of these expense, but you cannot claim the benefit for the STT while computing the capital gain. When we talk about the trader, STT is allowed as an expense. We will deal with it later on. Coming to the period of holding, as I already explained, the threshold for the listed shares are 12 months. But how will you compute the period of holding? In general, the period of holding is computed from the date of purchase of shares to the date of transfer. So if you are holding shares in physical form, then it is very easy to compute the period of holding. Basically, the broker's note and the contract's notes are considered to determine the date of purchase and the date of sale. But if, as all listed shares are actually held not in the physical form, but in demat form, so in case of demat shares, the period of holding is determined on basis of FIFO method. FIFO method means first in, first out. So let me explain this with you an example. Suppose if you have purchased shares of a Reliance on day one, 10 shares of a Reliance on day one, and on day two, you have purchased another 20 shares of a Reliance, and on day three, you sold out of 30 shares you have purchased on day one and day two. Out of 30 shares, you have sold 5 shares. So in this case, as the Reliance shares are listed and it is held in demat form, the shares you purchased on day one will be considered to be sold on day three. So the period of holding in this case will be based on FIFO method, and the days will be counted from the day 1 to day 3. Now, as I said earlier, if you are transacting through stock exchange, then capital gain is chargeable to tax at a reduced rate of 10%. But there are some certain benefits which are not allowed, which is actually usually allowed while computing the long-term capital gain in normal circumstances, like indexation benefit. You cannot claim the indexation benefit. What is actually the indexation benefit? Indexation benefit basically allows you to adjust the cost of an asset considering the impact of inflation. If I explain this with an example, let's say you have bought an asset for rupees 100 last year, and the similar asset in this year cost you suppose 110. So in this case, the difference is of 10 and it is due to the inflation. So I can say the inflation rate is 10%. So basically inflation represents the percentage by which the purchasing power of your money diminishes over time. So to adjust the cost of asset for inflation, we use actually basically cost of inflation index. Every year, the CBDT notify cost of inflation index, and the base year for cost of inflation index is 2001, financial year 2001, 2002. For the base year, the CII, cost inflation index, is 100. And if I talk about the current CII for the financial year 23-24, the current CII is 348. So suppose if I purchased an asset in 2001, in financial year 2001, for suppose 1 lakh, and now I'm selling it in financial year 23-24, then the cost, adjusted cost will be, for computing the long-term capital gain will be, I will divide the cost by the CIF of the year of purchase, and multiply it with the CII of the year of sale. So in this case, the 1 lakh will be divided by 100 and multiplied by 348, and the index cost of acquisition will be 348,000. So in normal circumstances, you can adjust the cost of acquisition with the inflation. But if you are transacting through stock exchange, then this benefit is not allowed, and you have to pay tax at the rate of 10% on the difference between the sale value and the cost and the transfer expense. Here, one thing I would like to mention that actually before Finance Act 2018, the long-term capital gain arising from transaction through stock exchange was used to exempt. But with Finance Act 2018, these shares are now taxable. So to provide some relief, the shares are actually taxable at a concessional rate, as well as if you have capital gain of 1 lakh, the aggregate capital gain of rupees 1 lakh during the year, then no tax is levied on that 1 lakh. But any the excess amount would be chargeable to tax. Suppose if you have earned 1,50,000 capital gain from the long-term equity shares, then 50,000 will be taxable at the rate of 10%, and no tax will be levied up to 1 lakh. Surcharge rate, actually the surcharge is varies based on the income slabs, in which income slabs you are actually falling. When assessee's total income exceeds a certain threshold limit, the tax on that total income is further increased by surcharge. For individuals, HUF, AOP, BOI, the surcharge rate goes up to 37%. And if you are not opting for the new tax regime, I hope you must have aware about the new tax regime. And you have opted for the new tax regime, then the surcharge rate goes up to 25%. But in case the long-term capital gain is arising from the transaction through stock exchange, the surcharge rate is capped to 15%. Thus, even if your regular income, suppose your salary income is exceeding the surcharge rate income slab of, suppose, which attract the surcharge rate of 37%, and you have long-term capital gain also, that even if your regular income or your salary income is charging is taxable at a surcharge rate of 37% or 25%, as the case may be, the surcharge on long-term capital gain will not exceed the 15% in any case. So can you please move to the next slide? As I said earlier, the long-term capital gain was used to be exempt if the transaction was through stock exchange before 1st February 2018. But in the budget speech, the finance minister announced imposition of tax on long-term capital gains arising from listed equity shares with effect from 1st Feb 2018. So to ease the burden on individuals who invested before this date, 1st Feb 2018, a concept of grandfathering for investment was introduced. How this grandfathering provision works? Basically, if you have acquired the shares on or before 31st January 2018, then the cost of acquisition of such shares are considered to be higher of the two. Basically, you take the actual cost and you compare the actual cost with the fair market value of the shares as on 31st 2018 or the selling price of such shares. Let me explain you this with an example. Suppose you purchased the shares in 2017 for suppose 100 rupees. Okay, and the government now imposes the tax in 2018. So what the government is saying that you can whatever is the fair market value of that shares on for 31st January 2018, you can take it as a cost. Suppose your actual cost was 100, and on 31st January 2018, the fair market value of that share was 150. So you can consider 150 as cost of acquisition. But suppose you have sold that share for less than the fair market value, suppose 140. Then in that case, the cost of acquisition would be 140, and you will not be liable to pay any tax because it will set off. But in case you have sold the shares for suppose 160, then in that case, your cost of acquisition will be 150, and as you have sold the share for 160, then the difference amount of 10 rupees will be taxable as per the new provisions, as per the amended code, as per the new section introduced by the Finance Act 2018. Tax rebate 87A. Actually, if you have total income up to rupees 5 lakh, then you are allowed tax rebate of 12,500 rupees from your tax liability. But if you are opting for the new tax regime, then this tax rebate of increases to 25,000, and the threshold limit for the total income also increases to 7 lakh. So if you have normal income, then this rebate is allowed. But if you have long-term capital gain from listed equity share, then this rebate is not allowed. Talking about the set-off and carry forward of losses, actually the set-off and carry forward of losses mechanism works in 3 steps. First, you do intra-head adjustment. Intra-head adjustment, basically, you can set off if you have income from the multiple sources under the same head. Then you can set off the loss from one source from the income from the another source. And if any loss remains, then inter-head adjustment can be done. Inter-head adjustment, basically, you can, if you have loss under the one head, then you can adjust the loss of that loss under that head from the income under any other head. And after inter-head adjustment and intra-head adjustment, any loss remains, then it will be carried forward for set-off in the subsequent years. Talking about the long-term capital gain, there is no distinction as such whether you are earning long-term capital gain through stock exchange, from transaction through stock exchange, or from off-market transaction. There is no actually the distinction. But the long-term capital gain can be set off only through long-term capital loss can be set off only through long-term capital gain. It cannot be adjusted from any other income. So if you want to set off it from, suppose, like short-term capital gain or any other business income, you won't be able to do it. Long-term capital loss can be set off only against the long-term capital gain, irrespective whether the long-term capital gain is chargeable to tax at 10% or the regular 20% rate. If any long-term loss remains after inter-head or intra-head adjustment, then you can carry forward it for 8 years. And in subsequent years also, you can set off it from the long-term capital gain only. Advance tax, actually, the advance tax is the device to ensure a steady flow of tax revenue to the government. You have to pay your taxes in advance. For computation of advance tax, you need to estimate, because you are paying taxes in advance, you need to estimate your income. Then if your liability is, after estimating the income, your liability is exceeding 10,000, then advance tax is paid in installments. But actually, the capital gain cannot be estimated in advance. So government has given the relaxation. Even if you are actually advance tax if capital gain is accrued if you have transacted through stock exchange, or even if you have even if you have capital gain from the off market transaction, then you are liable to pay advance tax only when the capital gain has accrued. You don't need to estimate the capital gain and advances. So you can pay advance taxes whenever the income has accrued. Sir, can you please move to the next slide? So this was all about the long-term capital gain. Now coming to the short-term capital gain. Short-term capital gain, the computation and the period of holding mechanism are almost is same, but in short-term capital gain, you will not allow the benefit of indexation because you are not holding it for more than 1 year. Actually, if I talk about the listed share, and even in general cases, you are not allowed the benefit of indexation from the short-term capital. Now, if you have done transaction through stock exchange, similarly, like long-term capital gain, the tax is charged at a reduced rate of 15%. And if there is an off-market transaction, then the tax is charged at applicable rates. As if you are an individual, then the tax will be charged as per the slab rates applicable in your case. Surcharge rate is also capped to 15%, but only where the short-term capital gain is chargeable tax at 15%. Basically, where the transaction is done through stock exchange. In case of off-market transaction, there is no cap at surcharge, so you have to pay surcharge as per the normal slabs. So can you please move to the next slide? Short-term set-off of losses and carry forward and advance tax, I have already explained. The only difference is that short-term capital gain loss can be adjusted against the long-term capital gain or short-term capital gain, but inter-head adjustment of the short-term capital gain is not allowed. So long-term capital loss can be adjusted only against long-term capital gain. Short-term capital loss can be adjusted both long-term capital gain as well as short-term capital. So I have already explained, so we can skip this slide. We can move to the next slide, sir.
So, guys, this is just a glimpse of everything we have discussed so far. Again, you can use this slide as a ready reckoner in case you want to just have everything on the single page. Now, coming to the next slide.
So, talking about the taxation.
Depend consider the time. We are left with just 18 minutes, so you have to speed up.
Okay. Considering the tax, talking about the taxation for traders, actually the traders have to classify their transaction in speculative and non-speculative. For example, intraday trading are treated as speculative transaction, but delivery-based transactions are treated as non-speculative. Speculative transactions are basically one where deliveries does not take place. So in intraday trading, delivery does not take place, then therefore it is considered as speculative. Actually, the tax treatment of speculative and non-speculative transaction are almost same, with two major differences. I will deal with I will talk about the differences in the later slides. Now coming to the tax on normal, non-speculative business income. So actually, whenever you have business income, you need to maintain your books of accounts. You need to get them tax audit. You can also avail the benefit of presumptive taxation scheme. For all of this, you need to actually check your turnover. But how you will compute the turnover? There is no actually the provision under the Income Tax Act, but we have the ICAI guidance on computing the turnover. ICAI has provided different rules for computing the turnover from speculative transactions or derivatives or from the delivery-based transaction. So first of all, let me talk about the maintenance of books of accounts. You are required to maintain books of accounts if your total income exceeds 1,20,000. This limit is 2,50,000 if you are an individual HUF, or your turnover exceeds rupees 10 lakh. The limit will be 25 lakh in case of individual or HUF. Here, I would like to highlight that it is talking about the income exceeding, or it is referring to the turnover. But when you see the income tax return form, income tax department does not allow you to actually enter the loss in no account case. So in case you have loss from the non-speculative transaction, then income tax department, though there is no provision under the law, income tax department requires you to maintain the books of accounts. Tax audit. Tax audit is mandatory if the turnover exceeds 10 crores. Actually, the 10 crore limit applies when 95% of transaction, at least 95% of transactions are done in digital mode. And in equity shares uh, through stock exchange, almost 100% of transactions are done in digital mode. So we can say that the tax audit is required only when the turnover exceeds 10 crore rupees. Availability of presumptive taxation scheme. Actually, we have a presumptive taxation scheme for small businesses under section 44 AD, where the small businesses are not required to maintain books of accounts and get them audited. But I don't think income tax department will accept the actually the person who is trading in shares. They get the information from their brokers about the transactions, contract notes, P&L, so they can easily maintain their books or even calculate the profit and loss from the transaction. So, though there is no restriction in the law in opting for the presumptive taxation scheme for trading in shares, but department may not accept because books of account can be easily maintained. Coming to the turnover, as I said, there are different tools for computing the turnover from speculative, non-speculative, and derivatives. In case of non-speculative transaction, basically the sale price of the share is considered as turnover. So suppose if you have purchased Reliance share for 2,000 and you have sold it for 25,000, then the turnover will be considered as 25,000. So can you please move to the next slide?
Dipen, before moving to the next slide, I think I should emphasize a few more points, guys, which you may frequently encounter from your clients or in your own cases. These are pertaining to tax audit and the presumptive tax scheme. So I'll just talk about these two common questions, which I think during the audit period and the written filing period, I normally get 40 to 50 queries every season. So what are those queries which I thought I should highlight? So just take an example. Assuming you are earning the salary income and you are also getting into the share market transaction. So do you need to get your accounts audited or not? So these two aspect which you need to consider is your turnover as well as the mode of transaction. Since I am just taking the example of wherein you have the salary income and just the stock market transaction. So since in both the situation, your entire transaction is being done through the banking channels. So in your case, the 10 crore limit would apply to determine if you need to get your accounts audited or not. So I know the 10 crore limit would looks very on a very higher side. But when I talk about the derivative, believe me, this number can be achieved easily in a month. So guys, whenever you get into the derivative transaction, the F&O transaction, in the subsequent slide, I'll be discussing about how you can compute the turnover. Using that, you compute your turnover and then determine if you need to get your accounts audited. If it is below 10 crore rupees, you don't need to get your accounts audited. That should be very, very clear to you. You may be misguided by any other person that you need to get your account audited. It's not required at all. At the same time, you should not assume it. You should not get your accounts audited if you are just earning the salary income and your net profit or loss from the stock market is below, let's say, just 1 lakh rupees. So in both the situations, you should be very careful. Otherwise, it may pose some challenges for you as well as the penalty. The next question is availability of the presumptive tax scheme. Uh, I know many practical cases wherein some so-called tax experts they suggest the taxpayer to claim the presumptive tax scheme. So, what is presumptive tax scheme? So, in Income Tax Act, we have a section 4480, which says you compute your income at the rate of 6% if done through the banking channel of your total turnover as your taxable income. So let's say I am getting into the share market transaction or the derivative transaction. So in both the situation, I simply compute 6% as my presumptive income. I pay tax on it. Guys, that is very risky, hazardous, I would say stand. Never ever take this stand, because department will never accept this stand, and they may issue a notice for underreporting as well as misreporting of income. In that situation, 50 to 200% of tax sought to be evaded will be levied as penalty. So always stay away from presumptive tax scheme when it comes to computation of taxable income from stock market. So now, Dipen, over to you. Dipen, you have to finish your part in next 2-3 minutes, because
Sure,
I have 10 more slides to cover.
sure, sure, sir. So as we have already discussed about the turnover, how you will compute the turnover in delivery-based transactions. So for computing the business income, you need to compute actually the purchase price or the cost price of the share, as well as you need to claim certain expenses also. So the advantage of showing trading as business is that a person claim deduction for all the expenses, whereas if you claim it as capital gain, then you will only be able to claim the transfer expense or the cost of acquisition. But if you are showing it as a business income, then you can claim expenses like internet charges, telephone charges, depreciation, office rent, staff salary, etc. Talking about the cost of acquisition, we have ICDS 8, which deals with the cost of acquisition of securities market, or actually the taxation of securities market. So cost of acquisition as per ICDS is basically uh, uh, is considered as the purchase price, and all the directly attributable expenses like brokerage, fees, taxes are added to the cost of acquisition. As per ICDS 8, as you are recognizing your income under the head business profession and ICDS 8 applies, you can even claim, you need to recognize the listed securities at cost or NRV, whichever is lower at year end. So if you identify that your share price is lower than the cost, or then you can recognize it at NRV. Suppose you purchased a share for ₹100 and the market price is 90, then you can recognize it at 90 and claim the difference as the mark to market loss as per ICDS 8. Tax and surcharge, the tax and surcharge will be normal as applicable. So if you are an individual, then normal slab rates would apply. Coming to the setup of losses and carry forward of losses, as I already explained, there are 3 steps in which losses are actually set off and carry forward: interhead, intrahead, and carry forward. In respect of business income, intrahead adjustment is possible. You can claim, you can adjust the loss from one source against the loss from other source. So if you have income from, suppose if you have loss from non-speculative transaction, then loss from non-speculative transaction can even be adjusted against the profit from speculative transaction, but vice versa is not possible. For speculative, if you have loss from speculative transaction, you can only set off against the income from speculative transaction. It cannot be set off from any other income. Further, business income cannot be set off against salary, gambling, online games, media, or investment income. If any loss remains after interhead or intrahead adjustment, then business loss can be carried forward for the 8 years. And in subsequent years, you can set off the loss only against the business. You cannot set off against any other income or the income under any other head. Sir, next slide, please. So I have almost covered everything about the business income and the taxation of normal speculative transaction and the speculative transaction is almost same, but there are 2 major differences. I have already explained about the setup of losses. Speculative losses can be set off only against speculative income, and they can be carried forward only for 4 years, in contrast to 8 years as in case of non-speculative transactions. Talking about the computation of turnover, in delivery-based transaction, we simply take sale value as the turnover, but in that non-speculative transaction, we take aggregate of both positive and negative differences arising from the settlement of contract. Suppose I'm giving an example. Suppose if you have purchased Reliance share for ₹2,000 and you have sold that share for ₹22,000 2200 for in same day, then the difference of 200 will be considered as a speculative turnover. But in contrast, if I take it vice versa, if you have purchased the share for rupees 2200 and you sold it for 2000, then there will be negative difference. But the negative difference will also be considered as the turnover. So if you have done these two transactions, then in this case, your total turnover would be 200 plus 200, that is 400. So both positive and negative differences are considered for calculating the turnover from speculative transactions. Next slide, sir, please.
Okay, Dipen. So I think thereafter I have to take it further. Thanks, Dipen. And now taxation of the mutual funds. Considering the paucity of time, I am skipping what are the mutual funds. This is very common. We all are very educated about the basic securities terms. So types of mutual fund, I'll quickly explain. So you can say those funds which invest entirely in equity shares, those funds which invest entirely in debt-based, and a hybrid mode, which invest a portion in the equity, portion in the debt, or portion in the gold, or maybe some portion in the US stock market. So the taxability would definitely depend on these three factors, the kind of investment these mutual funds make. So here is a glimpse of the taxability of different mutual funds. So we have divided into four parts: investing 65% or more in equity, 35% to 65% in equity, up to 35% in equity, and debt instrument. So period of holding to become long-term capital asset, 12 months, 36 months. These two categories are always deemed as short-term. So this change, guys, minded, this change has been made applicable from 1st April 2023 by the budget 2023. Indexation benefit, I'm assuming you sell all of this through the stock market. So I'm assuming you guys would pay STT. Considering that thing into a mind, the indexation benefit would be allowed only in this scenario and in none other cases. Nature of capital gains, the first and second can be long-term or short-term, but the last, third, and fourth will always be short-term. The first one would be taxable as 15%, the short-term, and the all other at the applicable tax rate. If these are unlisted, then the applicable tax rate. And if these are the listed one, the long-term capital gain, then 10% without indexation. 35% to 65% equity, 20% with indexation. Other remaining cases, applicable tax rate. If these are the unlisted one, then 20% with indexation, and the last, third, and fourth, applicable tax rate. But the first and second case, in case of a non-resident, it would be taxable at 10% without indexation benefits. So taxation on dividend from shares or mutual fund, if I talk about the a resident person, they will always be taxable as part of your normal income. Dividend income are taxable under the head of income from other sources. So just like your any other income, like your interest income, it would be taxable as the applicable rate. However, you can claim a maximum 20% of your dividend amount, not of your interest expenditure. Of your dividend amount, you can claim as a deduction from your interest from your dividend income. You cannot claim any other expenditure, whatever charges you have paid to the bank or to any other person to recover those dividends. No deduction would be allowed for that. Only the interest component can be claimed. So the tax rate, as I mentioned, applicable tax rate, the surcharge, the pen has covered this aspect in detail. Yes, the surcharge capping would be there for 15%. And the advance tax, since you can't predict when your dividend income would be declared or received, so there is a relaxation in terms of computation of advance tax. You would be liable to pay advance tax only after the dividend has been received and credited to your account. Now, taxation of future and options. Again, I am just skipping the background. What are future and options? I'm coming straight on the taxation aspect. So, guys, this is the most important slide, and if you understand this point, you will understand all the taxation of F&O. So the most important aspect is how do you compute the turnover in case of F&O. As you have already seen, why computation of turnover is very, very important when it comes to calculation of your business income, be it from the stock, securities, or the F&O transaction. So the Income Tax Act is silent. How do you compute the turnover in case of F&O? The only guidance we have is the ICI guidance note on tax audit. So the recent one, and in fact, the ICI has recently revised the guidance note on tax audit, and this is the latest position on how do you compute the turnover from the F&O. So you can see there are 5 business rules. In case of secured of transaction, the total of favorable and unfavorable difference is taken as turnover. I know would be very difficult to understand. So in the next slide, we have given you many examples. So I'll explain each rule with the example so that you actually understand how these rules are actually work. So in case of scale of transaction, the total of favorable and unfavorable difference is taken as turnover. So you can see that the first row is positive, the second row is negative, first row is again negative, then the second last row is negative. So we have got many negative numbers, but when it comes to the turnover, I have taken all the number as positive to compute the total turnover. So that's business rule number 1. Now, premium received on sale of option is also to be included in turnover. So what I have done, I have uh, this one. I have sold a put option in ITC case, and how much amount premium I have received as well as the paid. So I can take both ways. So in that situation, you can see that I have taken this amount, 3,000 rupees, as part of my turnover. In respect of the reverse trade, the difference thereon should also be part of the turnover. So again, ITC has got that wherein the reverse trade is, I have paid 40 rupees and I have received 10 rupees. So I have done a reverse trade. So it means there is a 30 rupees of, I would say, the amount which either I have paid or received, that does not matter. So that's the amount which I need to consider for the purpose of computation of turnover. So 30 multiplied by 100, that's 3,000 rupees, and 3,000 become part of my turnover. In case of an open position, it will be ignored. So you can see that I've got 2 open position in IOC and Axis Bank. So I have not considered both this part in computation of turnover. That would be considered in the next year when they are actually squared off. In case of delivery-based settlement in derivative transaction, the difference between the trade price and the settlement price shall be considered as turnover. So here is an example. I have taken, let's say, Cipla futures, and I have settled it uh, at the end of the future, जो भी उसका term था. So the settlement price 610, the strike price 1495, the net profit 57,500. In the case of BHEL, I have incurred loss, but for the computation of turnover, both 57,500 and 20,800 would be part of the turnover. So that's how these 5 business will work. Again, you can take a print of this slide and keep it as a ready referencer. Now this is done. So that's all. And guys, before I take up the Q&A, I should quickly highlight about the certification course by the NISM, and that's a wonderful course. Uh, we, as a tax expert, we have made this entire content, and this is very precise and to the point, and fully fully authenticated and verified. You will have complete information when you take the certification course. So who should take this course? All those individuals who want to know about the different taxation aspect in the securities market, interested students and professionals, any other individual interested in gaining knowledge of taxation. Guys, there is a famous quotation. I do not remember the name of the gentleman, maybe Albert Einstein. So he said, death and taxation both are uncertain. So if both are uncertain, it's always good to know about this uncertainty. We can't come to know about the death, but at least we can come about the taxation. So guys, we strongly recommend you to consider this taxation of security certification course. So these are all the aspects we would be covering. We have covered in this course. The taxation of equity, debt, ESOP, every damn security you can think about has been covered in the certification course. And again, be it from the intermediary point of view, the foreign portfolio investor, IFSC, or the individual shareholder, every aspect has been explained. And end to end, you don't need to refer any other book when it comes to the taxation of the securities market. So after you are done with your preparation, there would be 2-hour exams, and there would be negative marking of 25% of the marks assigned to a question. Passing score is 60%, and the certificate will be valid for 3 years. And the fees is just 1,770 rupees. And number of question, total 75 questions would be asked, out of which 50 question would be of 1 mark each and 25 question of 2 mark each, adding to total 100 marks. And these are the other certification courses offered by the NISM. So before I say thank you, I would like to take some of the questions, and I'll take this liberty of skipping some of the questions which we think we have already answered. And if you again refer to the slide, you will have your answers. Capital index bond, can you please explain one more time what is taxation? Stock market I've covered. Unlisted equity is taxed on personal slab. Is there any difference? Unlisted equity taxed on personal slab. Is there any difference in short term and long term? Yeah, definitely. So we have got the question from Anish Mehto. So unlisted share is taxed on personal slab. Is there any difference in the short term and long term? Yes, there's a difference. We have already explained it. Why if ETF holding period 36 months for long-term gain, but in equity-oriented mutual fund long-term holding period is more than 12 months. So if your ETF is entirely equity-based, the period of holding would be 12 months, not 36 months. However, index option profit taxed. So index option, when you say indexed option, do you mean to say ETF or derivative? So I'll explain both. So when I say ETF, you need to bifurcate into, I'll go back to the slide, which we have explained, this one. So you can refer to this slide. If your ETF invests entirely in equity, then your first row would be applicable. So depending on the amount of AUM that ETF invest in the equity, your taxability would be decided accordingly. But if I talk about the derivatives, your derivative transaction will always be taxable as business income, guys. Just keep this in your mind. There is no other situation except in case of FPI. In all other investors, your derivative income would always be taxable as non-speculative business income. That should be clear. So presented derivative applicable for index intraday, never. If you want to take a chance, take it. But guys, that's I'm giving you surety. You will definitely be caught, and department will issue a notice. Capital gain statement of mutual fund issued by RTA is not in line with as sought by income tax department. Investors have to calculate for filing of the income tax forms. Some file trouble for filing. Is it possible to issue capital gain statement by RTA sought by income tax department? Guys, that's not something I can help you with. You need to talk to your broker or change your broker. Can an individual also claim these expenses like depreciation? And if you're a trader, you can claim all the expenses like depreciation and brokerage. If you're an investor, you cannot claim. Should I invest in infrastructure funds as it is believed that India needs good? Guys, I and Dipen are chartered accountant. We are not investment advisors, so we can't give you any opinion on that matter. If foreign company holds shares of private limited company, when sell shares to other foreign company outside India will be taxable in India. If foreign company holds shares of private limited company, when sell share to other foreign company outside India will be taxable in India. Guys, Dheeraj Vora, the question you have asked, this question is worth 12,500 crore rupees. Why I said so? The same controversy was there in the Vodafone's case. Thereafter, the Supreme Court gave decision in favor of taxpayer, but the law subsequently changed. So there's a big story, and we can have a separate webinar to explain this, how this transaction is now taxable in India. So this is not relevant for today's webinar. I'm skipping it. So guys, I'll take a pause. If you have any query and you want to ask me and Dipen after this webinar, you guys can follow us on Twitter or LinkedIn, and you can ask your query. And we always try to answer every damn query we get on LinkedIn and Twitter. Is a short-term capital gain calculated after 1 lakh profit? No. Every single rupee of short-term capital gain would be taxable. There is no exemption for first 1 lakh rupees. What is FEC? I don't know, guys. Sir, if my total taxable income is, guys, I'm skipping the calculation part. We just talk about the law part. I know many guys are sharing their factual issues, so we don't have much time to discuss all these issues. What is the difference between transaction through stock exchange and off-market transaction? Rupender Ghosh. So let's say, Rupender, you and me want to exchange the shares, and I do not want to route it through the stock market, and I just want to sell you my shares. So in that situation, because I do not want to lose the control of my company, and I just believe you, or there could be X number of reasons. So I transfer those shares directly to your demat account. So this is the off-market transaction. Then corporate tax rate, which has to file for carrying forward. So which ITR form is to be filed for carrying forward of losses? So if you're an individual, the only ITR form available to you is ITR 2 and ITR 3. You guys cannot file ITR 1 and ITR 4. If loss from the you get to what okay, so what is the taxability of mark-to-market profit losses on derivative transaction? Anonymous attendee. So first is you can't do mark-to-market losses on case of derivative transaction. that deduction is allowed. So we have ICDS 8, which allows you to claim a deduction for mark-to-market losses. So it says at the end of the financial year, you have to compute the losses or the gain. You would say the notional gain or losses. You need to compare the cost of acquisition with the fair market value on the last day of the financial year. If there is a loss, that mark-to-market losses, and that would be allowed as deduction under Section 36. But if there is a gain, it would be taxable under Section 28. Akshay, you will have the slide, and you can again go back and see the slides of mutual fund and F&O. Yes, you will get the copy of the PPT. Can you guide for taxation of NRI staying in USA? So all those factual points, guys, please message us either on LinkedIn or Twitter. We'll answer your questions. Okay. Mituji, some people are asking what is the benefit in getting the taxation of security certificate. Though I have explained it from my point of view, I request someone from NISM also gives his point of view perspective on why they should get the certification course. I think with that, I'm sorry guys, I won't be able to cover all the questions. There are many points in the chat. I just could take 10, 20 queries. So considering the time we have committed to you, I have to stop this presentation now. Now over to you, Mituji. Maybe you want to answer these questions of security certificates.
Sir, this is Kiranjit this side.
Yeah, please, ma'am.
So for this particular certification course, the candidates, this is basically an aspirational certification examination. Those who want to know the detailing of taxation applicability with reference to securities markets, so they can take this course. And for all the details, like they can visit our website on the certifications tab. We have detailed information about the certification examination, and also they can call us at 8080806476. So will be available. I have put the number in the chat box. I will put it again for reference, and it is also available on our website. So for detailing, they can get the information. So, with this, I would like to propose a vote of thanks. So on behalf of NISM, I thank you, Naveen sir and Dipen sir, for such an enlightening session and like informing our audience about various important aspects of taxation related to securities market products. So I also thank our audience for joining us and participating with their queries and giving their feedback throughout the session we have been reading. Thank you everyone and have a good evening.